welcome to this week's Halftime Talk. We're honored to be joined by one of the world's most respected oil commentators, Mr. Christof Rühl, Senior Research Scholar of the Center on Global Energy Policy at Columbia University, former Chief Economist at BP, and Senior Global Research at ADIA, the Abu Dhabi Sovereign Wealth Fund. Christof has a deep reputation in the markets, and Christof, welcome.
Thank you. Thanks for having me.
Christof, we kick off the month of August with all of the issues swirling around, and yet oil prices remain locked into what seems 41 on WTI, 43 on Brent. Is there anything, do you think, on the horizon this month that would break oil prices out of that pretty tight range?
We enter the holiday season, but I'm not sure it's going to be a big driving season. So spontaneously, I would say no. There's nothing obvious coming which would kick the oil price either way. And as longer it continues like that, the more likely it becomes that we will see a movement downwards just as much as upwards. So remember, August a few months ago was supposed to be the time of the year when we were well in the second leg of the V-shaped recovery, when oil demand, consequently to the economic recovery, would pick up, and everything would be on track to return us back to the end of 2019. Levels of demand for oil and levels of economic activity and all that. That becomes increasingly a doubtful proposition.
The one thing that has been sort of guiding this journey of the last few months has been inventories building massively, of course, in the second quarter, and the expectation that they would start to come off in the third. And over the last few weeks of July, they've been inconsistent, up one week, down the other. Do you think we can get to any trend line on inventories, and what would that be in your opinion?
They should start to slowly diminish. I mean, step back and you have this enormously complex picture. First of all, we have to recognize, even when we talk about oil, that oil is at the receiving end here. So we have energy markets hostage to the economic situation. We have the economic global situation hostage to the pandemic situation and the efforts to fight the pandemic. And this idea of a synchronized recovery is increasingly going out of the window and being replaced with great diversity and divergence across countries for the pandemic, for the economy, and consequently for energy demand and oil demand.
It seems like we have this kind of battle between COVID resurging and the stimulus that keeps coming, and which one will win?
Well, the stimulus, has the potential to mostly translate into price increases, first for assets and maybe later for flows as well. That would then be inflation much down the road. The economy has the problem that the longer the current stalemate continues, the less likely it becomes that you see a smooth synchronized recovery, simply because parts of the capital stock start degrading. The human capital, the labor market, starts to become more complicated with people out of work 3, 4, 5 months. It's much harder to kickstart the engine. And so consequently, you will see more and more structural change being necessary to get to high growth rates, and that makes it more complicated for the economy. And for oil demand, when you think about where the growth centers were, they were in India, they were in China, and they were in the Middle East. Large parts of the rest of the world didn't grow its demand anymore, even before the crisis. You see that Chinese growth is slow, that India is in a big mess potentially with again, starting on top of the pyramid with the disease and the virus. And then the economy in the Middle East with low oil prices is not a big demand engine anymore. So we'll see that coming. And I think, coming back to your question about inventories, the one thing OPEC and OPEC Plus have right and recognized is that they have to wipe out these excess inventories. Because I always say this is like for OPEC or for people trying to manage the market, this is like driving a big truck. And if you don't have an immediate reaction when you press the pedal or when you move the steering wheel, then it's very hard to drive that truck across a curvy road. And this is what happens when you have inventories. When you have inventories,
and yet there are increasing production by 2 million barrels from the 1st of August. It doesn't seem to be the time to be adding more supply.
There's very little choice, because in order to keep people online and keep the alliance together, you need to stick to the plan. They have already added an extra month of cuts. they have already have added the promise, at least, that those who were cheating, can you still see me?
The camera has dropped out. There, it's back.
Okay,
Yeah.
good. So they have already not only added this, they have already also the promise that those who have not complied will make good for it. There's a huge element now whistling in the dark. These, saying that yes, we will add 2 million, but they won't come to market because we will burn them in the summer. We, Saudi Arabia and Russia, is only to 50% true for Saudi Arabia. There's no cyclical summer increase in demand in Russia. Saying that we will have, the people who did, the countries who didn't comply, cutting extra is whistling in the dark. And of course, it's for a reason, because demand hasn't picked up to the extent necessary to pick up the slack. But nobody could know that back in April when the deal was struck. And the last thing you can do now is to unwind the deal over something like that. So they will have to continue as good as possible.
There was when this started, this OPEC agreement, and there is a review next week by the JMMC. It was started with this trilateral US, Russia, Saudi agreement, or this alliance, grand bargain, call it what you will. And even last weekend, we had Donald Trump in Texas, of all places, thanking and praising the Russians and the Saudis. Apparently that didn't go down very well. Perhaps one of the reasons why his numbers don't look so good in Texas. But your outlook for this trilateral relationship in terms of managing the global energy oil markets, is it sustainable? Does it have legs?
In the very long term, it will break up. I mean, I give you the detailed answer, but you have to step back a little bit. In order to see what's going on there, we have to talk about a situation where oil markets change fundamentally, and that is that you have peak oil demand. I have no idea whether 2019 has seen it or not, whether it will come back for 1 or 2 years. But I know when I look at the numbers, when I take into account oil efficiency improvements and all that, we are in a range of no more than 10, 15 years and oil demand will peak. Doesn't mean it will decline dramatically, but it will plateau. In the OECD, this has already happened in 2005. What we have to recognize, and what is still not recognized widely enough, is that the moment oil markets stop to grow and are shrinking, the whole game changes. It will no longer be possible for cheap suppliers like the OPEC countries, OPEC plus countries, to increase prices by cutting production. When you're in a market which is falling, which is shrinking, then just to keep your own production constant, you need to take market share from somebody else. The only way to do this is by price competition. So we will switch into a regime where you will see these guys competing on price. The price war between Saudi Arabia and Russia, that was a first taste of what's going to come. That is a situation then of durably lower oil prices because of this price competition as long as markets are shrinking. That will change everything. And it will change so much, in particular for the Gulf countries who depend on these revenues, that they will think about alternatives. And the only conceivable alternative to me is one where the three big producers get together and continue the dialogue they have established in this emergency situation last April. And one way or another, basically come up with a quota regime as we had it historically between Big Seven and all that, in order to stabilize market shares for all of them. The US would have an incentive to do that because in a world where price competition rules, they would lose their status as an oil exporter. Saudi Arabia certainly has a huge incentive to do that because they are so dependent on oil revenues, and they would lose big time if prices drop more than volumes. Russia, the opposite, they don't have an incentive to do this because they would love to see the US losing their dominant energy status. Right now, in Russia's eyes, the US can impose energy sanctions with impunity because they have nothing to worry about.
Does that get affected by a change in administration?
Sorry?
Does it get affected, this sort of sense of balance, by a possible change in administration in Washington, do you think?
It's a big question because right now we don't have many statements from the Democrats and from Joe Biden of what he wants to do with the oil patch. We have a lot of abstract talk about the energy transition and cleaning up, and we have a lot of people in the campaign who talk about shale oil as something which is not to be supported and all of that. But in his sort of pronouncements out of his basement so far in the last few months, there was nothing. about what he wants to do with global oil policy. It's kind of absurd because people don't think about this anymore. They think about the energy transition, rightly so. But oil is still the largest fuel we have. It still goes directly and indirectly into any economic activity we can conceive of. It's terribly important. And I would not put it behind the sort of ideological framework of the Democratic Party to say, let's regulate that market, you know, under the banner of let's impose stability and let's make a deal and let's regulate it politically.
Well, you would think
It's an off
if
chance, it's a 10% chance, but it's a real chance. And for the rest of the world, in the times of a big economic crisis like it is unfolding now in the wake of the pandemic, that's bad news because a high oil price is still not very supportive of an economic global recovery.
When you look at
let me say one more thing also to be very clear. Your question, oil price stuck between 40 and 43, very stable, right? Isn't that what OPEC Plus said all along? We want a stable oil price. Now they have it, but it's not good enough. Why? Because of course the game is about a high oil price, not about a stable oil price.
Well, they certainly need. They're all managing massive fiscal deficits, so they certainly need more revenues from the oil price. One of the big parts of that equation, the US, Russia, Saudi deal, was to, in a way, save the US oil industry, save shale from collapse and 1 million unemployed jobs. It seems to have, to a certain extent, failed, but still the oil production in the US holding near 11 million barrels a day. What is your outlook for shale? There's been a lot of narrative in this crisis that shale is going to get whacked, yet there's huge stimulus and lots of money looking for things to invest in. Strikes me that shale still has another lifetime.
Of course it has. This reminds me of, you know, this discussion 10 years ago about peak oil from the supply side. All of a sudden, shale is in trouble. Shale was never any good. Shale is disappearing. This is frankly just nonsense. I mean, you don't produce millions and millions of barrels of oil every day when everybody loses money. It's just not going to happen. It has never happened. There always have been profitable spots in shale. There always have been, like in any upstart industry, you know, there have been deeply indebted parts of shale, there have been unprofitable parts of shale. The way I look at this is that the increase, the financial sector restructuring and reorganization which takes place in the shale patch will make that sector stronger and not weaker. They may lose a few 100,000, maybe 1 million barrels as long as prices are at 40, but they will come out the other end like they always did, stronger. And I'm having some other sound here, sorry. And I think what we have seen in the past will be replicated just more strongly. The US is just a perfect example where you have a very sensible bankruptcy and financial restructuring system. So you will see assets changing hands. And at the end of the day, you will see increased productivity from that segment of the industry. And of course, it is here to stay. It will not disappear. 10 years down the road, you will see shale gas coming out of China massively. This is not something which, you know, was done by bad banks and then financed in some fancy way and then being wiped out again. And that's not how the world works.
And in that perspective, what's your sense of where that number goes? We saw the rig count last week, and the last 2 weeks now seems to have kind of bottomed out. What's your outlook for US production?
The rig count is, of course, sort of looking in the future because that's mostly driven by exploration. And I see shale as something which has proven to be very flexible with a very short response time. So low amplitude, high frequency in this oil cycle. And that means that the outlook on production strictly depends on the oil price. I think the break-even part of that will decrease through this financial restructuring in the industry. And this is part of the OPEC Plus dilemma. The more successful they are, the higher the stable oil price is, the more competition they get from shale, but not only shale, also from Brazil, from the North Sea, from other patches in the world, now from the Yukon in Guyana. So what we also have to remember, and what most people, even the industry people, don't realize, is that in oil, cost follows prices. You know? I was working for a big oil company, you mentioned it. Guess what? We had the same return of capital when the oil price was in the 20s for a decade than we had when it was 120. Why is that? Because costs from labor to steel to service industry adjusts, follows prices with a lag. there's literature on that. The lag is somewhere between 6 and 18 months. It is shortest where you have thick infrastructure, like in the shale patch. It is longest where you have not much infrastructure, like in the deep water. But it adjusts everywhere. And guess something else, it adjusts much faster in the private sector than it does in the state-driven sector. And so you have this game now with OPEC plus cutting, stabilizing prices at some level closer to what they need for their fiscal problems, and then the private sector adjusting costs downwards, which is in full swing. And that's why we never see these kind of investment gaps, OPEC and the IEA always together jointly pronouncing coming. And suddenly you see a response from the private sector with more production. That is the kind of game which works in a growing market. That's what I meant initially. So then it has always been like that. It's nothing new about shale. The OPEC cuts, low-cost producer cutting production, building prices up, have helped to support the North Sea. They have helped support Alaska. They have always allowed the private sector to free ride, always. And that's not going to go away. And it's going to happen again now with shale and with other places where production takes up because of prices stabilizing and the private sector driving prices down faster than the state-organized sector. That's a dilemma. And when you now, just to close the circle to the previous thought, when you're now in a world where markets are no longer growing, where you cannot, currently you cut, you get higher prices, and then because markets are growing, even what you have cut, eventually you claw it back, and your calculation is revenues equals volumes times prices, you're fine. In a shrinking market, you can't. In a shrinking market, if you lose your own production, you have to lower your price to compete with your neighbor. And that means durably lower revenues, and that means instability of the economic sort and the political sort. It's going to be a very, very difficult transition. And it seems to be driven by the oil market, not by the energy transition, not by peak oil demand because people don't drive cars anymore, but by oil just being too much oil on the planet, just like Yamani said, Stone Age didn't for lack of stones.
When you put the middle of that, the oil majors, if we just focus on them as they're very much in the news at the moment, vis-a-vis their earnings season, the numbers that came out in the last few days, devastating losses in the second quarter, to be expected, one would generally have to acknowledge, but nonetheless still quite devastating. I'm wondering, what do you think the impact of that is? We've seen massive announcements pre the earnings season of capex cuts. Well, how do you see this moment in time impacting the major oil companies and how that will change their journey forward?
They're in trouble and they're defending themselves with the best way they know how. And there's two defense lines. First, they're in trouble. It's interesting to see when most oil analysts were pretty upbeat and said the oil price is going up because of these OPEC plus cuts and the low prices, forcing private cuts as well. The market in general didn't buy it because you saw oil prices going up, but you didn't see the value of these IOCs going up. And what they do now is, I think they do the two things they know best. They cut costs that will be a benefit in the long term, but they also take huge charges, impairment charges. And what that means is, of course, that when the going is bad already, so you eliminate part of your capital value, and when you then look at the rates of return on capital or on investment, it will improve automatically, even if your returns don't improve if you have taken an impairment charge before. To some extent, that's a preparation for a recovery. But I think it will be very difficult for them. So it has to come down in the end to cost cutting, not these impairment charges only. They won't help. And we are in a journey where in the third quarter, you will see improvements everywhere because of the low basis which has been established now. You will see the economy suddenly growing very fast, and you will see Mr. Trump saying, we finally broke through it. And you will see, of course, oil markets recovering to some extent because not something stellar has happened, but the second quarter was so miserable and so dismal and so bad. That will boost them a little. But my best guess is that the oil companies will have to swim through that bad patch, which can be of a long time period, by adjusting cuts and by downsizing. And these promises which have been made of producing at zero carbon and joining the energy transition, so this will come back to haunt them because there's no way they can finance it from extra profits from the oil and gas segment. And there is no way in which, as my book, in which as a huge international oil company, you can suddenly start to act like a utility and produce wind and solar power at a profit anywhere close to what you made from oil and
So
gas.
are the European majors making a mistake that the US majors are not and committing to the transition?
In my own personal opinion, when you ask about the sincerity of it, yes, because they cannot deliver. That doesn't mean that they may have not more than tactical reasons. They may genuinely believe that's necessary. They may certainly generally believe their shareholders will demand it from them. But I mean, I think they go the way the tobacco companies will be going. I don't understand where the competitive advantage of a BP or Shell is when it comes to clean energies. I don't see it.
Massive ability to project manage, to draw on capital, to coordinate talent.
They are not the most efficient when it comes to manufacturing businesses, as we have seen in the sale bets, not at all. Their business model is geared to single large projects with superior engineering capacity and a large sort of environment which buttresses these projects with political risks and with economic risk that manages that. That is not necessary when you build wind farms or solar. If it comes to new pioneering things, then I could imagine it. If suddenly hydrogen would be, something which has to be injected on a large scale in the current infrastructure, then maybe. But that's not really on the horizon. What we see on the horizon is either technological advances of the small kind, which all we know is big companies are not very good at doing, or this painstaking granular adding a windmill here and a solar park there and expanding the system, which is manufacturing business in which they are very bad. So I have a very hard time finding the kind of niche, which niche is actually the wrong word because it has to be a pretty large niche for them to deploy their abilities.
100 million
to
barrel
join that energy
niche.
transition. Just because you produce energy, it doesn't mean that you're good at producing the kind of clean energy the planet wants.
But
and we have to be clear about this. We only had historically an energy transition in the sense of replacing the dominant fuel twice in the whole history of mankind. Once when coal replaced wood, and once when oil replaced coal as the dominant fuel. And the first time, it wasn't just an energy transition, it's not for nothing called industrial revolution. It was a complete transformation of everything. And coal was an ingredient which was necessary. No coal, no steel. You couldn't have done it with wood. And the second time, when oil replaced coal, it was an economic advantage, comparative advantage. Oil was cheaper, higher energy density, easier to store, easier to transport, easier everything. It was economically superior to coal, and therefore it replaced it first everywhere, including under the boiler. It was only later that it became specialized in transport. Now the modern wind and solar and whatever you want to use, they don't have any of these characteristics. They are not driven by economics. They are driven by a change in preferences. We, the people, say we don't want to poison the environment anymore, and therefore we want a different fuel. That's a shift in preferences. And now what we need to do is to make these new alternatives competitive and make them cheap. There is no industrial revolution which requires wind or solar. The only revolution technological-wise which we have is the internet and digitalization. That works with power, but that power can come from coal. My iPhone doesn't care whether it's powered by coal-generated electricity or water-generated electricity. And much less is it the case like when oil replaced coal, that the new energies are economically superior. They're not. They're subsidized all over the place because they're more expensive. So it's a completely new undertaking. And then you look at the system, how large actually the old hydrocarbon system is compared to the tentative changes which we have established on the renewables. And you look at these oil and gas companies and you scratch your head and you think, where exactly is the technological or comparative or other advantage they have to kickstart this energy transition?
One of the things that have made the oil majors, I mean, there are many reasons why they've been successful and have sustained support, and that has been their dividends policy. By hook or crook, by hell or high water, or whatever the analogy you want to use, they have given dividends on a solid level to major institutional investors, pension funds, etc. What is your outlook for that, and could they be at the tipping point of possibly losing those investors?
So it's a yes. It's the answer for the short term, and no is the answer for the medium or long term. If I'm right, and if you're in a world where oil is durably lower priced and will become a more normal market. I mean, let's face it, the oil market is the only market where the low-cost producer cuts and gets higher prices. The only market we know. Once that becomes normalized and the oil price is a bit lower, you will see dividends coming under pressure, and you will see it. You already see it. Shell cut, BP will cut. Everybody expects it at least, and that's of course very difficult for these companies, because when you believe that you're an oil and gas company which has to join the energy transition and change its entire business model, you want some breathing space, and you buy breathing space by keeping the dividend high, and then use that sort of time frame and the support of continued demand for your stocks to implement this transition. When you have a cut in the dividend at the same time that you're trying to turn on the needle, so to speak, to change your business model, makes it all the harder. But my short-term outlook is, because of low oil prices, they will have to continue cutting dividends. That's number one. And then in the longer term, if they don't find outlets for investment to foster the energy transition, and if they don't want to continue investing in oil and gas at the same degree as they used to in a growing market, then what people mean when they compare them with tobacco companies is that they have a high dividend model, because then you don't have many capital expenditures, and you take that money which you save, you have your operating costs. We have a loyal customer base, so to speak, just like tobacco companies, loyal smokers, but not a growing market anymore. And what you use to invest, you pay out in the form of dividends. And the same for the oil companies. You have people still driving, still a high demand for oil and gas, but you don't want to expand anymore. You want to stay away from the limelight. So you basically give up on investment. You have your operating costs, and the rest you pay out as dividends. And make no mistakes, tobacco companies have done very well the last 10 years.
A risk-free posture. It's kind of an interesting outlook. Let's come right back to where we started to wrap up, Christof. It's August. The COVID pandemic does appear to be recovering. I mean, resurging, lots of fires burning, lockdowns, local lockdowns. And sort of capping the recovery that was meant to come. What's your immediate outlook for the rest of this week, for the rest of this month, where those two battle?
Yeah, I think we see a quiet summer, and quiet might be disappointing also for people who have hoped of the recovery. And then we see desynchronization. I mean, this will be it looks like being a terribly messy autumn. Everybody will run around sniffing. Nobody knows that they have the flu, does they have COVID, does they have just a cold. Vaccine may be developed, but not ready yet. So I see that very messy. And so that means people will have to learn to live with the pandemic. And relaxation will continue. And we will have some changes in our, we will wear masks in the supermarket. But fundamentally, the economies have to go back. And on energy markets, on economic growth, again, the longer the current situation lasts, the more structural changes will creep into this economic model which we have. It will not be just a matter of recovering. It will be also a matter of some companies closing, some new companies opening, and that makes it harder. So I would expect a very uneven and very messy situation far into 2021.
Well, as they say, the longer it lasts, the longer it will last. It becomes kind of embedded into the economic structure. Listen, we'll wrap it up there. Christof Rühl, thank you so much for joining us on this week's Halftime Talk. Absolute pleasure to get your insights on where the energy markets are going, both in the immediate term and the longer term. Thank you, Christof, for joining us.